Good morning, everybody. Thank you very much for joining us today. We've had lots of interesting questions in the past. Hopefully we'll get lots of interesting questions today. So if we can, we'll go straight to slide 4. So for the year as a whole, I think it'd be fair to say, we're pleased with the results we've managed to produce. Solid performance. With the underlying profit margin sitting at 24.5. It's been a challenging year for a number of reasons, and it's easy to forget quickly how much happens in any one given year. I mean, we've had the war in Ukraine throughout the whole of this year, which has disrupted all sorts of markets. We've seen interest rates rising faster than certainly at any point in my career. So in addition to which you can add, and I nearly forgotten about it there as well, Trustonomics, which is now a year ago, incredibly, but which caused major disruption in the various markets, including in equity and clearly in bond markets. So it was a challenging year. So to produce 24.5% profit margin, which in our sector is pretty good, is pleasing, and Andrea will dive into more of the financial figures in a moment. Flows were positive at 5.2% net for the year. That's up from 4.8% in the year before, which again is pleasing. We'll give you some more detail around gross inflows and gross outflows, because there's a really interesting story around where the money's coming from and where it's going out as well. But suffice to say, if there's one takeaway, it would be that our gross inflows were a new record for us, the highest gross inflows we've seen into Brooks Macdonald in the 32 years that we've been going, which is great news. From a tech perspective, we completed the transition onto SS&C, so that platform being front, middle, and back systems or processes. So a big piece of work. That was in July of last year, so we've been live there for 14 months now. But we have also been increasing the investment in tech across the board with new technology for our financial planning division. And we're now in the process of bringing on Salesforce, which is a CRM, into the whole business and replacing half a dozen different CRMs, which we did have before. So very much a part of our becoming more efficient and effective, which we'll talk to more as we go through. 2 really great acquisitions completed. I'll talk more about M&A later, but both Integrity and Adroit have integrated into the business very quickly. We knew they would. We'd known them for 10 years, both companies. So we knew that culturally they were going to be well aligned. And talking of culture, Consumer Duty is very culture driven. Again, I'll talk to it a little bit later, but we were well positioned for it. It was a lot of work to get it to complete what needed to be completed around value assessments, etc. But I think we are very well aligned with the regulator in that regard. And in terms of the future, which is what any dividend increase is about, clearly the board are confident that we can continue the great growth record we've had over many years, and we increased the dividend by 5.6%. Up to 75p, which hopefully is pleasing for all of you who are shareholders already. With which, let me pass to Andrea, who will take us through the figures.
Thank you, Andrea, and good morning, everyone. So, Andrea Montague, I'm 6 weeks into the role, and my priority really has been to get to know the business, get to know our people, and importantly, deliver the year end. So, with that, if we can turn to slide 6, Andrea has already mentioned a number of these, so I won't dwell too much on this, but I think worth pointing out, revenue up, and we delivered a set of results, a robust set of results yesterday in line with market expectations, and that is against what was a very challenging macroeconomic conditions, with average markets down by 6%. Pleasingly though, as well, I look at net assets, which is an indication of the strength of the underlying business, and also cash, which is strong. I go on to it, but we managed through the year and had 2 acquisitions through the year with still a strong cash balance and also strong balance sheet to support the business going forward, with an underlying profit margin of 24.5%. So then let's get into the numbers in a little bit more detail, but I'll keep it quite high level, and we can cover any questions on it later. So if we turn to slide 7, please, Hannah. I've highlighted just the key financials. We've covered most of these, and in fact, at our Q4 update, disclosed the flows. You know, again, there we saw strong flows into platform in particular, with 1.3 billion into MPS. That represents an organic growth rate of 65.6%, which again, you know, really strong inflows in particular that we've seen throughout the year and continue to be in this quarter as well. Andrew will touch more on gross flows and net flows later in the pack. So I'll turn now, Hannah, to revenue, please. So we've touched on these. I think this is actually better covered in the pack when we get to gross flows, but those are the numbers that I talked to, 5.2% up on the right hand side there of inflows. Behind that, very, very strong gross inflows. These are the net numbers, and I think that's very important for us as we face into Q1, where we are seeing headwinds in flows, but Andrew will cover that. So page 9, revenue, just briefly then pulling out a few key facts from this. Overall, the group's yield has gone up from, you'll see on the left-hand side, by 1.2 bits. So I've done a bridge to try and keep this, well, I like things simple to try and keep it clear. So, you know, in terms of book mix, we've talked about over some time, the move from BPS to MPS has had an impact on our bits, but also the impact of the relaunch of the Cornelian Fund there at 1.3 bits down. We've obviously seen increased non-fee income, which is a combination of interest income and transactional income going up, and that is a natural foil in difficult markets to total fee income. And we'll cover a little bit later the mix and as well as the yields as well. So I think what I would also pull out in this importantly is that we made 2 acquisitions in the year, which are you know, also supporting the underlying profitability of the group. So yes, strong momentum in the business, but it's against a background of, you know, strong macro or challenging macroeconomic conditions. So turning now then to costs, the other side of that. So increased costs from 87.7 to 93.5. What I've set out here is a bridge across. As you know, if I pick out a couple of points from this, importantly, the acquisitions, we acquired Integrity and Adroit, and they've added 2 million to the cost base. The important point is they've already added 500,000 to profit, and that's just in 1 year. So really strong acquisitions from what I've seen of them so far, and importantly, the teams are settling in well to Brooks, and we've got forecasts in line with what I would expect in terms of increasing revenue coming from those and profits. The other thing I would point out, I think importantly on this, which no doubt we can get into in Q&A, is 3.2 million on SS&C. So Andrea in the past has outlined our transition and migration to SS&C. That is now complete, pleased to say, and is really there to support our business going forward. And from a finance perspective, I see this as a huge positive for the group. We have got a very competitive rate card with SS&C, and that protects us from inflation, and it also means that as we grow volume through this business, that cost base will fall. So it's a leveraged impact on our cost base, and it will support improve efficiency in the future. So turning now to balance sheet, I've already mentioned a strong balance sheet. We remain well capitalised with 15.2 million surplus. I think it's important to step back to say that we have no debt on the balance sheet. We've managed to pay dividends, invest for organic growth, inorganic growth, continue to run the business and still have a surplus, which in the current market conditions, I think is the right place to be. And then finally on cash is the next slide. Slide 11, Hannah. I've touched on this already, so you can see that on to the left of that slide, strong operating cash flows, strong cash generation from the business, and we've used it importantly to pay dividends, which I recognise is important to our shareholders, and the other large proportion there is on the purchase of the two Adroit and Integrity that I've referred to. So I think another demonstration of our strategy to grow the business and be able to invest and support a growing dividend, which I know is important. So that was a very quick canter through. I'm very happy to take questions, and I'll hand back to Andrew.
Great, thank you very much, Andrea. Okay, what I want to get into here first is the opportunity, the structural fundamental opportunity that exists for Brooks Macdonald, but also for the UK industry. Those of you that were with us 6 months ago and a year ago will have heard me banging on about this before, but I do think it's really important. So in terms of wealth in the UK, the demographics dictate that we need to have bigger pots of money to provide for lengthened retirement periods. And you can see that the predictions are that this moves gradually from 4,000 billion, 4 trillion up towards 5 and through 5 over the next 3 years or so. As well as that demographic piece, you've got a policy shift that we've seen over a period of time now, and which is effectively that the onus is upon us to look after ourselves as we go into retirement. The good old days of your DB scheme looking after you as you wander through a pleasant retirement. Hopefully there'll still be pleasant retirements, but now it's defined contribution schemes, and you're very much responsible for your own pot. Now, with the simplification in inverted commas of our pension system over many years, realistically means that everybody in defined contribution needs to be taking advice at some point on that route towards retirement. Pension freedoms alone mean that anybody can take all of the money out of their pot in one go, which normally would be a terrible idea. So people need to take advice, and people are recognising this. So you can see the number of ongoing clients with IFAs. That's moved from just over 2 million in 2016 to 3 point something in 2022. So the message is getting out there. People are worried, people are concerned, people are needing to take advice, which is fantastic. But let's also recognise that 3 point something million is only around about a tenth, and let's assume that that's husband and wife. It's still only about 20% of the working population. I actually got some new stats through this morning, which I'll share with you, which are that this is from HSBC, that just 9% of adults receive financial advice. 28% of adults who have more than 50,000 of assets have an advisor. So 72% of the population that has more than £50,000 of assets do not at this point in time take advice. And I think that that's going to have to turn around as we go through the coming years and as people come towards retirement. It's also that the assets in the advice gap, so those people that aren't taking advice, average at 119,000, which is down a bit from last year because of markets, but it's still over 100,000. So every single one of those is a good client. So I think just in terms of the opportunity for the UK wealth management industry and advice industry, I think the opportunity is huge. For us, who are working in two spheres, so within as a financial advisor in our own right, but also providing investment solutions to advisors, the bottom left chart is hugely important as well. So IFAs are expecting to continue outsourcing more over the next couple of years. So this was a survey last year, so it's this year and next year it's referring to. And that includes MPS, and we'll go on to talk about MPS in a minute, but that's where the majority of our growth is coming at the moment. But it's also in funds, and fund of funds in particular, so multi-asset funds where we have two ranges, and in bespoke. So whilst bespoke solutions have come under a bit of challenge recently, the expectation is still for advisors to outsource that. And to me, that's entirely logical, because when it gets bespoke, it gets complex. And to be able to run those sorts of portfolios, you need to have the full setup, and advisors are not going to want to spend all of that money to try and do that themselves. So I think bespoke is actually a really important area to be involved with, as well as MPS and as well as funds in the years ahead. Then bottom right, what we're showing is it's a very fragmented industry, and this is the wealth management industry. The IFA industry is immensely fragmented. There's huge numbers of IFA firms, and you can tell that because there are 30-something private equity-backed consolidators working in that IFA space. We buy IFAs and add them into our private client world, but we'll come back to that in a moment and explain how we do that and why we do that and how we do it safely, which I think is the key. So if we move to slide 15, this is what I'd call a link slide. We've got 3 strategic value drivers. This is what's going to increase the value of the business over time. First of all, organic growth. So we managed 5.2% this year. How can we increase that? We've got a medium-term aim of getting to 8 to 10%. So we'll come on to that in a moment. Service and operational excellence, which is really how do we improve what we provide to clients and advisors and run our business effectively and efficiently. And then the M&A piece as well, which is the inorganic growth, which can add scale, but also add capability to what we're doing. So if we can go to 16, we'll kick off with market-leading organic growth. And there's a couple of really important stats in here. So if you look at H2 FY23, you can see that our inflows, annualized inflows, were running at 19.3%. That's the highest we've seen in terms of percentage that I can remember, although in the early days it would have been those sorts of numbers. But in terms of gross inflows, as I said earlier, that's the highest we've ever seen, which is fantastic. And Andrea touched on the fact that in Q1 of this year, so July and August, we're continuing to see high levels of inflows. Indeed, July and August were higher than the 2022 equivalents. But you have got the contra to that. The outflows at 13.5% are being affected by a couple of not issues, but cyclical events. And that's really around the movement in interest rates. So we've gone from us not receiving anything on our bank accounts. Interest rates were very close to zero for a long, long time. And they've very quickly moved up into 5+%, which means that you and I can now get over 5% on our cash, on our money market funds. And critically, our debt has moved from a mortgage rate of 1.5 to a mortgage rate of 4.5, 5, even 6 at 1.6.3. I think was the average two-year fix. So it's very logical for someone to be given advice or to take the initiative themselves and pay down a bit of that debt. And that is what we started to see in May and June of this year. That's carried on into July and August as well. And I think that's right and proper and cyclical. That's where we are in the market. So gross flows are fantastic, and we think pipeline looks good. We think gross flows will continue to be strong, but we do expect outflows to be strong as well in this period until people see rates roll over and start having some certainty as to what future costs are going to be for them, whether that's living costs or debt costs. So what we've guided to is that in this quarter, we're going to see negative flows. Next quarter, not sure. And then as the year goes on, we think that we'll move back into positive flows. This is an industry point rather than a BM point, but it's an important point nonetheless to make. Now, I do want to just touch on, if you just flick back for a moment, Hannah, thanks. I do just want to touch on why we're getting those really high levels of gross inflows, and they're detailed down this left-hand side, or at least 5 of them are. You know, the partnership culture is hugely important. Culture, full stop, is hugely important within Brooks, and the partnerships that we form with IFAs and have done for 20 plus years now are really the driver of our success. It's about working with IFAs, not on selling them an investment solution. It's about working with them to make their businesses successful and to provide the greatest possible outcome to their clients. So that partnership culture, alongside an investment proposition, which I think it continually needs to evolve, but where we sit today, I think it's absolutely right for market. The distribution capability that we've got there across the UK and beyond, you know, the fact that we're continually driving to get improving services to clients and to their advisors as well. And critically, the investment process, robust as it is, churns out good, strong results for clients. So client outcomes look good. So if we go to 17 now, Hannah, that'd be brilliant. Thank you. This is platform NPS is where the really fast growth is. Andrea mentioned we've got 1.3 billion of flows in this area in the last year, and over FY23 we're running at 70% growth. Now 70% growth isn't going to continue forever. That's evident. You just can't do that. CAGRs don't carry on doing that, but we do expect it to continue growing strongly. And we also expect to continue to increase our market share. So we're 1.5, it was 1.8 into 21, 2.1 into 22. You know, our aim is to move that up to 5% of what is a growing marketplace. So we're excited about the NPS side. I would also say the BPS side is hugely important to us too. So we definitely need to have both of those capabilities. In terms of, on slide 18, what we're doing around service and operational excellence, this is mainly around our work with SS&C. So as I said, we moved on to the platform, finishing the migration in July of 22. So we've been on there for 14 months now. It is about improving that advisor experience and the services that we can provide to clients. But it is also about scalability. Andrew touched upon the fact that we've got a cracking deal with SS&C, and as we add assets to that platform, we do not add costs, not excessive costs. So that will help us to drive operational leverage, and that will drive the overall margin of the business as we carry on through. And then with regards to M&A on slide 19, this is Andrew's mentioned that we undertook 2 acquisitions of Integrity Wealth Solutions and Adroit Financial Planning, both in the IFA space, both building scale, as you can see on the right, in private clients. You know, they come to us normally with some assets being run by Brooks. That's how we know them. And as I said, we've worked with both of these companies for a decade, so we knew what we were taking on, and that's kind of critical. We have 4 really clear criteria for any acquisition that we're making, and you know they are that we buy quality businesses. So we're not in the business of sorting out fixer-uppers. There must be economic benefit in it for us. We must see accretion. The price has got to be right for both parties, not just for us. We could get a great deal, but then the people that have sold to us will think they've been done over, and there'll be an unhappy relationship. So there's got to be a good deal for both parties. There's got to be strategic value. And I talked to the fact that Integrity, 3 of the senior Integrity leaders are now leaders in our wider business. So they've taken roles in Brooks Macdonald Group, which is fantastic. And then the critical point is culture, and making sure that they are aligned to our culture before they come on board. And that's where you get You know, you might have a wonderful strategic fit, but if you've got opposing cultures, you're just going to fight, and it's going to blow up, and it will be just value destruction, which is exactly what we are trying to avoid. So we will carry on with our M&A. We looked at many firms in this last year, and you'll see in the accounts that there's £1 million worth of costs in the P&L for acquisitions that we didn't complete on. You know, that's a difficult decision, but if you get to the point of due diligence where you realise that one of those 4 criteria are not being ticked, you are better off walking away and taking the cost on the chin than spending years and years focusing on remediation rather than on the growth of the business. So don't apologise for those costs, which I hope will be less in future years, but certainly don't apologise for them. Just a couple of more points. Consumer duty is a big regulatory piece for the industry this year. There's always one every year, but consumer duty this year, and for me, I think this is a real opportunity. We had RDR 10 years ago. I believe consumer duty takes that on another step in giving the public more reasons to trust the financial services sector, financial advice in particular in the UK, that they are going to do a good job for them, that they're not going to rip them off, because this is all about getting clients good outcomes. And I believe that we are well aligned to it. The guiding principles that you can see on the right-hand side there, that we care, that we're connected, we do the right thing, and then we make a difference. We've been in place here for 6 years now, and absolutely are the foundation of the culture of the business. And I believe that is very aligned to what the regulator is trying to drive through. So it's a big project, but we took it on, and we've driven through it, and now it's about making sure that we embed the ideals of consumer duty in the company, which I don't think will be difficult given the principles. So just to conclude, a couple of slides to conclude. In FY24, you know, we are expecting net flows to be positive for the year, gross inflows to be really good. Short term, though, we expect gross outflows to be significant, to the extent that we expect this quarter to be negative. The mix of business, so taking in lots and lots of business in MPS at 19 basis points and having mild outflows in BPS, and I do mean mild, I think it was £50 million over the year in total in BPS at 85 bps, clearly creates a drag on the revenue yield, but not necessarily on the margin. Interest, which has boosted revenues this year, we think will be slightly down in FY24, but only slightly. And costs, clearly inflation is still a big issue, and we would expect, whilst our SS&C contract doesn't have inflation in it, which is really important, you know, with all of our staff require increases, and our other suppliers will be going for inflationary increases. So mid-single digits is where we're aiming there. And then in terms of the future, you know, incredibly positive about the future. You've heard me just talk about the opportunity. I think we've got a huge chance to do something really special over the coming years. We are aiming for top quartile underlying profit margin. You could argue we are at the moment. Depends what peer group you pick, but we're up there. Aiming for 8 to 10% net flows. I think we're not going to do that this year because of the headwinds that I've mentioned, but the aim will be in 26 possibly to get to that sort of number and to become a top 5 wealth manager. And the management agenda is exactly what I've been talking about with regards to our value drivers. So it's organic, inorganic growth, operational efficiency, and providing the best possible service to our clients. And you know, our purpose is to realise ambitions and secure futures for our clients. And you know, our aim is to be able to realise ambitions and secure futures for a fast increasing client book. With which we look forward to your questions.
Thank you both for that helpful presentation, and for anyone who hasn't yet seen it, we have published a research note on our website with updated forecasts, which you can find at Equity Development. So on to questions. What drives flow in MPS, i.e. why are you winning share?
Yep, good question. And I think if you, on that market, that organic growth slide, I think the 5 points down the left-hand side are really the key. You know, it's partnerships. When you are working against other firms in that MPS space, there's three areas you have to look at. One is around your performance, and our performance is robust. It's good long-term performance, so we stack up well there. It's on price, and everyone's pretty much in the 15 to 25 basis points world. We're at 18.8 average, and 20 is our standard. We had an IFA come to us with a couple of 100 million, so you discount when you've got those sorts of numbers coming in. But those two things are pretty homogenous. Most people are in the right sort of ballpark. So it comes down to the service that you're providing. And as I was saying, you walk into an IFA and you talk to them not about selling them an investment product or an investment service. You talk to them about what are you trying to achieve with your business, and what are you trying to achieve in terms of your client outcomes. And then you start from there. So you talk to them about what an investment service might look like to help them achieve what they're looking to achieve. And then you talk to them about what else we can do to help them. So can we help them with regards to marketing to new client segments? Can we help them with regards to consumer duty? How are you dealing with consumer duty? This is what we've seen. This is how we can help you. You know, we don't do consultancy, but I have IFA CEOs ringing me up going, this is what I've seen, what are you seeing, how are people dealing with this? All of that sort of stuff, which is all about partnership. And to be honest, partnerships are just so much more enjoyable than a selling sort of relationship. So that's how we like to work. We're people, and I think that comes over. I think that's why we're successful.
Okay, thank you. Perhaps as an adjunct to that, how much of the market trend of growing MPS and declining BPS is left to run? And perhaps, you know, how close are we to the point where the switch between the two stops?
I think it's got a bit of a way to go. Now, so if you are running standard BPS, old school BPS, let's call it, then I think there will be outflows to come, but I don't think they're huge. What you're seeing is advisors moving away from undertaking advisory investment management, where they're running the portfolios and they send an email out to their clients and ask their clients to email back saying, yes, okay, you can make that change. They're moving away from that, partly because what an enormous pain it is to try and run a business like that, and partly because they're taking all the risk of the investment management on their own shoulders. So there's a realization that their specialism is in financial planning, and actually outsourcing that risk is good for them and their business. So if that's the main driver of the MPS flows, the BPS side, it's not so much how much you've got leaving, it's the reality that advisors have shifted from BPS as the default solution for outsource to MPS as the default solution for outsource. And I think actually it's right. So MPS and multi-asset funds actually, in the accumulation phase, when you don't need anything special, you don't need bells and whistles, is entirely appropriate. You can do it pretty low cost. You're putting money in it every year. It grows. You don't pay much attention to it. Your advisor says you should do this, that, and the other, and you crack on. At some point, you'll get to, or hopefully you'll get to a point where either the size of the pot is such that you need bespoke advice because you've got money in your own name, you've got it in an ISA, you've got it in your SIP, so it matters what types of asset you have in each of them. So you need something bespoke for that. Or you might need something bespoke in terms of the relationship because you're a vulnerable client and you need more explanation, more hand-holding through the process. Or, and I think this is where BPS will really find its place, is in the decumulation phase. So where you've been accumulating for 30 years and then you're about to go into actually taking an income from your assets, that switch point is you are very vulnerable during it. The sequencing risk is enormous. If you have big market moves whilst you're making that shift, it can be really painful and really affect your the long-term ability of your portfolio to provide an income. So I think we've produced a service which we've been running for 3 or 4 years now, which is specialising in getting through that period and providing an income in retirement. And that needs to be done on a bespoke basis. And I think there's a real opportunity for that. So I don't think it's the death of BPS. BPS has definitely still got a place to play, but I think it's for specialist situations going forward, rather than it just being the default solution.
Extremely helpful. The trend of outsourcing to advisors, the investment management piece, you obviously just touched on it now, but and it sounds like it's still strong, but how much of the low-hanging fruit has been captured, and is it an uphill struggle to get the rest to switch at this point?
Well, we're not finding that. The pipeline for our investment solutions, say partnership business, Brooks Macdonald Investment Solutions, it still looks very, very significant. We're having lots of conversations with people about moving away from their management to ours. A stat I got through the other day, I think it was in the platform statistics, that 34% of firms are still running on an advisory basis. So I think a lot of those are going to make that shift as we go through the next few years. So I wouldn't be at all surprised if, rather than eating each other's lunches as wealth managers, we've still got that outsourcing shift to come from, let's say, half of that group, so maybe 20% of the total. And then remember that all those people that are outsourcing the new money all the time. So what we're seeing in our MPS flows is you might have a bulk transfer, and that might be 50, 60 million quid or 150 million quid, but then you're also getting the monthly flows coming through. So we were starting off, only 3 years ago, it was sort of £10 million a month coming into MPS through normal flows. That is multiples of that now, every month. So it's, I'm still very positive about that for quite a period.
Loud and clear. Okay, onwards. What's the future of your Channel Islands business, and will it become a larger part of the group, or might you consider selling it?
Yeah, all good questions. So what we're doing with it is that we've been reorganising it. It's a difficult market, the international, and we've taken the view that the priority for the business should be the private client wealth on Jersey, Guernsey, and the Isle of Man. So it is a very fragmented set of islands. In terms of the companies that are actually providing for clients, there's no leadership there. We strongly believe that we can step into those shoes. If I'll give you an example, in the UK, SJP is generally recognised as being the leader in wealth management. There isn't an SJP out there, and I strongly believe that we can pick up on the good things that SJP do in the UK, and we can do the other things even better than they do internationally. So I think there's a leadership opportunity there for us. We always look at all parts of the business and validate their part in the group on an ongoing basis. So if we felt it was the right time to sell it, we would sell it. But actually, I think there's a really good opportunity there.
Okay, well, you raised SJP, which leads me into this question. In the context of Consumer Duty and the challenge to St James's Place's fees, is there a huge opportunity for your private client business to take some of their business?
Well, I think there will be if they have to get rid of the exit penalties. Until that happens, it might be a bit difficult. So, but I do think. I'm not going to talk too much about SJP. They've got a brand new CEO who starts 1st of October, actually, doesn't he? Who we know is a very high quality operator. So he'll get his teeth into that in due course. But I don't think we need to worry about taking clients from other people. As well as our name gets out there for being a really quality operator in that private client space, I've no doubt we will take clients from various competitors, but I think the priority for everybody should be new business for people who aren't taking advice at this point in time. You know, if people are getting advice from wherever it is, that is a better place than getting no advice at all. Given the restrictions that the regulator puts around us, you know, you shouldn't be getting ripped off if you're with one of the, sorry, ripped off is wrong. You should be getting bad advice or missold advice from any of the main operators. Whether you're overpaying is another thing, but just making sure that people are getting advice, I think, has got to be the priority. So our getting out there, getting our name out there, talking to the right people. So things like we're the financial wellbeing partner for the Professional Cricketers Association. We're the financial wellbeing partner for the Family Business Association. Those sorts of initiatives, I think, get us in front of people who have got wealth but actually aren't taking advice. Most people, and I'm sure this is the case on the call, you know, have gone through their careers just accumulating stuff, you know, and then it's, well, what do I do with all of it? And that's really, I mean, ideally you take advice from the start, but at that point where you think, what do I do with all of this? You've really got to sit down and take some proper advice.
Okay, thank you. One for you, perhaps, Andrea. Underlying margin has dropped off quite sharply this year. How quickly do you see it recovering, and do you think you can get it to over 30% in the medium term?
It's a good question. So, yeah, so the underlying margin has dropped. I mean, there's a combination of factors behind that, including the markets, so which Andrea has already covered. I've got confidence in the future. This year, I think, will be challenging because of the macroeconomic conditions that we're all facing, high interest rates. But when, you know, this is, for me, I keep things quite simple. It's the income and cost, jaws. As long as we can grow revenues and flows and keep our costs, which we do really in focus, there is huge potential for this business to increase operating margin over the medium term. I do feel this year will be a challenge. We talked about that, but you know, if we stand here today, we look at our peers, we're in a good position currently. Everyone will be facing the same factors, but back to SS&C, that leverage point, keep our costs down, growing volumes through that platform will help us towards a higher margin. Certainly what we're all aiming for.
Yeah, absolutely. And if we can make some judicious acquisitions that increase the funds under management on the platform, then 30 is definitely within grasp and beyond.
Okay, thank you. A pushback here on the BPS service. If the service is so good, why are you losing higher margin BPS business at 85 BPS?
Yeah, so I do think it is this shift in dynamic between BPS and NPS and accumulation and specialization. You know, this is about having the right service in the hands of the client at any point in their investing life cycle, and I think, you know, if you've got a 45-year-old in BPS with £500,000 in his SIPP, he doesn't need to be in BPS paying 85 basis points. He should be paying 20 basis points plus platform costs. So it's probably 45 basis points, something like that. And that's really one of the things that Consumer Duty and RDR before it have been trying to make sure that people are in the right service. So we're not seeing much of a shift there. And you know, once people have got a relationship with somebody, they like paying for it. It's not something that they want to move from. But you see a small amount of that, and then you've got the normal reality of things, which are people. I think it's a terrible thing, but people need to spend some of their money to live on. So if you're in a bespoke portfolio and you're in retirement, you need an income. So there's a natural level of attrition in these portfolios, and that doesn't mean clients leaving. It just means we might be paying out 4 or 5% a year to clients so as they can pay their heating bill.
An important thing to pay. Right, this is looking like the last question, unless, oh, hold on. well, I think it's very persistent on the BPS point. It's 50% of AUM. What's the churn? So I think you've largely touched on that. The churn is headed to MPS and natural attrition. So let's move on to one here on acquisition. There is clearly a focus on growing the financial planning private client business with the Adroit and Integrity acquisitions. Is there also an opportunity to move FUM from the external providers they use to Brooks Macdonald? And if so, isn't it worth pursuing a larger advisor acquisition?
It's a really good question. So we look at investment managers and financial planners in terms of acquisition, and it looks different in terms of what you choose to buy. In the investment management world, it makes much more sense to buy scale. So you don't want to be buying 200, 300 million pound investment managers with possibly slightly eclectic investment processes and the like, because we're only going to have one process for one set of clients, and it'll be ours, so they need to conform with ours. So you're limited in the number of people that you'd want to bring on, and if you're going to go through all of the work, you might as well make it a big acquisition. So scale is quite important there, which means that you don't do very many of them. Might look at a few, but you don't do many. Now, on the financial planning side, it's contra to that. So if you take on an IFA with £5 billion worth of assets, within that you're going to have hundreds of advisors, and that makes it quite difficult to culturally bring all of those advisors on and keep those advisors happy. You're actually better incrementally adding people so that you can spend the time with them, bring them into the business, and make them feel part of Brooks as you go through the process. So, I mean, Adroit was 350 million, Integrity 275. I think there's a sweet spot up to probably £1 billion of assets under advice. So we're looking from 100 to £1 billion, and somewhere in the middle of that is likely where we end up. So, and that's much. You know, we're here for the long term, and if it was just a case of, you know, consolidate for the sake of consolidating so you can sell the business on a slightly higher multiple, which is what the consolidators do, then fine. That's not our raison d'etre, as is to build a sustainable business which, you know, provides great service to its clients over a long time period.
Well, thank you very much for that helpful Q&A session. A reminder to our viewers to fill in the feedback form when we end the webinar, and we look forward to catching up with both of you in 6 months' time.
Cool, brilliant. Thank you, Hannah, and thank you very much, everyone, for listening.
Thank you all.
And your questions.